Hey friends, Lucian here with the Bullish Bears team, and I wanted to make this video on how options work. If you're just stumbling upon this video and you haven't taken our free options trading course yet, make sure you head over to bullishbears.com and take our free options course because it kind of brings everything together. We explain and break down the simplicity of options, the different terminologies, and we kind of work our way up and put it into like a whole course to kind of help our members and our followers just to kind of again, options could be a very confusing concept, so we try to do our best to simplify it and basically teach you about the concept of options and how they work in our course, and not necessarily the minutia and all the details behind it, because we don't want to confuse people, because again, options can be very confusing. So for the sake of this video, I'm just going to touch on how options work just using a very helpful resource called investopedia.com that you can always reference at any time. But again, take our free course if you want to learn more about options. So if you come down here, I'm just going to read this couple paragraphs here that Investopedia says, and then I'm going to show you on an options chain what it actually looks like. But this is just an example of options and kind of how it breaks down. So from the Investopedia.com, what they're basically saying is, let's say that on May 1st, the stock price of Corey's Tequila Company is $67. And the premium cost is $3.15 for a July $70 call. So that would be a $70 strike price call, which indicates that the expiration is the third Friday of July, and the strike price is $70. The total price of the contract is $3.15 times 100, which equals $315. In reality, you also have to take commissions into account. Now, remember, this is what's key. Remember, a stock option contract is the option to buy 100 shares. So each contract is the equivalent of 100 shares. And that's why you must multiply the contract by 100 to get the total price. So if you look right over here, the premium cost of $3.15, it's times 100, and that's what will give you the total price. So the strike price of $70 means that the stock price must rise above $70 before the call option is worth anything. Furthermore, because the contract is $3.15 per share, the break-even price would be $73.15. So in theory, I mean, there's other things that come into play too, like time value. So you could, in essence, break even if you haven't, or actually you could be in profit before you've technically even broken even with the stock, with other things like time value that come into play. But just for the sake of purposes of this video, the simplistic part of it is you're taking the premium price and you're multiplying it times 100 shares, and that is the total value of your contract. And you will take the actual strike price plus your premium, which is right up here, and that will be your break-even price. So the stock would have to move your direction to get to that break-even price and then move into profit. So just to show you what that looks like on a simple options chain, I'm going to go over to Options Express. Right here, this is the SPY or the S&P. It's very popular to trade with options, but just for this video, let me do something simple like Facebook that most people know. And you'll see on this options chain below, you'll see bid and ask prices. So the ask is what you can purchase this options contract for if the market was open. Right now I'm making this video after hours, but if the market was open and you paid the ask price, you would get this contract for $11.30 or $9.80, whatever strike price you go with. But remember, it is times 100 shares. So every price that you see here is times 100. So your break-even price would be the strike price plus whatever you pay for your option. That would be your actual break-even price. So obviously, if the last price of the stock was $117.27, you would add the 107 plus the 1173, which is, what is it, $118.30. So once this moves up to $118.30, you've technically broken even. That's, again, not taking into other factors like time value as well. Again, make sure you take our training course, our free options trading course on our website if you want to learn more about options. But that's in theory how it works. You know, this right over here is the call side, which means you believe the stock is going up. This on the right side over here is the put side, which means you believe the option is, or the stock is going down. So again, you'll see the premium over here on the call side. You take this plus the strike price, so the premium plus the strike price, and that's your break-even point. And you would just take your ask price or whatever you end up paying for it times 100, and that's the total value of one contract. So let's say you were buying this $107 strike price. It'd be $11.30 times 100, which would be $1,130. And then it would be times the amount of contracts that you want to have. So if you did it times 5, you'd be controlling 500 shares of Facebook, you know, it would be $11.30 times 100 times 5. So that's, I don't know, like 5 or 6 grand. So that's how it breaks down. Now on the put side, it's a little bit, it's the opposite. So you would take the 109, let's say you looked at this one here, or let's round up, let's go $120, and the ask price was $4. So it would be $120 minus the $4 would be your break even. So that would be $116. So Facebook would have to go from $117.27 down to $116 for you to break even. So you could put it to somebody else. You know, if this drops down to $116 Facebook, you could put it to somebody else for $120 in profit. And that's one of the beauties of options, is that you can make money in any market. When the market goes up, down, or trade sideways, you know, there's many different strategies to making option, or to profiting with options. And that's why people love to use options, is because, you know, rather than with traditional stocks where you can only make money when the market goes up, you can make it in any type of market. You can make money in any type of market with options. So again, it's just whatever you see here, the ask price times 100. And then to break even on a call side, it's the strike price plus the premium or whatever you end up paying for the price of the stock, or for the price of the contract. And over here for the put side, it would be the strike price minus the premium price is your break even. So the more it falls below, let's say if you did this one right here, the 120, the more it falls below $116, the more profit you make. The more up here that it goes, that Facebook goes above the $118.30, the more profit that you'll get. So that's how options, you know, break down, you know, the value of an options contract. Again, there's lots more moving parts that go behind it, and that's why I encourage you to head over to our website at bullishbears.com and